We will stand on principle, or we will not stand at all.
Hello everyone, this is Thierry Ruiz here, and this is another episode of Principle Discord. This time we are joined by Ekkehard. Ekkehard, thank you for being here.
Yeah, thanks for having me.
So you have two hats. You are the founder of Geneva Macro Labs, and you also have a role within the ILO.
Exactly.
So tell me a bit more what you do within the ILO.
So I'm an economist by training, and that's also my main role there. I'm heading a small group of economists, macroeconomists mostly, to look into labor market trends, future of work related issues, and technology, how this affects jobs, incomes, productivity. So that's kind of a more analytical researcher role that I have at the ILO. And so three years ago, as you mentioned, I founded Geneva Macro Labs together with some friends here in Geneva, to actually find a way of translating that kind of more analytical work I do at the ILO into concrete sustainability solutions on climate change, on work, on jobs, on new technologies, etc. So we are trying to find applications, impact projects that actually help in promoting some of the problems or solutions for problems that we currently face in the global society and economy.
So you're helping us putting together the Monetaryresetnet event, and you will be moderating a panel on trade, monetary policy, and CBDCs, central bank digital currencies. But within this topic of sustainability, how do you see tokens helping the sustainability aspect within your role at Geneva Macro Labs?
So one thing that we promoted very much since we did our blockchain conference last year here together with the UN was to find solutions together with private actors. We believe that policymakers themselves can no longer be the only actors in terms of addressing sustainability issues. And one concrete example that we developed together with some friends and also with Ralf Shami, who is coming to this panel next week as well, is to find solutions on promoting sustainable policy solutions for oceans. So in the oceans we have natural capital in terms of fish, in terms of blue whales, in terms of plankton, etc. And these natural assets contribute and help us to solve climate change. Now, how do you translate that into a digital token? The idea is to really create a new asset form that would be linked to natural capital, for instance, for fish, to blue whales, etc., and promote solutions that would help private investor to seek sustainable investment opportunities to invest in these kind of tokens. So in that sense, we believe that the digital tokens create basically a new asset class that help us valuing natural capital, and we want to promote this solution because we believe that this way we bring the policymakers who will regulate these tokens together with the private sector as actors who promote this change in this area.
Yeah, it sounds a lot to me like carbon credits, but in a digital form. So if you correct me if I'm wrong, what I understood is that you're trying to materialize human capital and overall basically global public capital, public goods as well, that would be somewhat valued so that people can care more about those and then eventually do something about it in an equation where there would be a complete new economics behind it, I understand.
Exactly. That's exactly what we believe, because we believe that for the moment what we are trying to achieve for instance in terms of addressing climate change is to regulate. We put in quota, we put in restrictions on certain activities, etc. But we believe that there is actually a public willingness to support this transition, and in order to kind of leverage that support and in order to make it fruitful to this kind of problem, we believe that bringing the financial markets in terms of digital tokens to that equation would actually link, exactly as you mentioned, the carbon credit to natural capital and help financial investors to kind of get some returns in terms of in the form of carbon credits by investing in these digital tokens that are linked to natural capital to animals.
I also see a lot of interest from the private sector and the funds themselves who want to have a responsibility fund, to be able through that to quantify what their impact is. Let's change gears a little bit and talk a little bit more about labor and inflation and CBDCs and central bank policy. The way I can link all of these is it seems that globalization has created a secular trend of deflation, and that has an impact because central banks have somewhat failed to push CPI inflation so far, or the only thing they have done is increase asset inflation, unfortunately, or fortunately for some. But what is the state of labor there? What is the play with the Taylor rule, inflation, labor, monetary policy? Could you tell us more about what you think are the biggest challenges there, and how you would approach those challenges?
I think in terms of this inflationary period that we have been living through the last several decades, I would say that there are two major trends. One is globalization, as you mentioned, and that's an obvious, clear fact. I mean, there are some estimates on how big it is, and it would amount to at least half of the decrease in inflation that you see is coming from globalization. But there's another effect, and it will become stronger and stronger over the next few years, which is demographics. The fact that we are aging fast in many advanced and major emerging economies means that basically the pressure on wages will slow down. And you see that, or you can measure that in terms of how much cost pressure companies still face. So it's even if you look at the unemployment rate as such, and before the COVID crisis, it was relatively low in most advanced economies. Nevertheless, the wage inflation it creates is extremely little, and it has something to do with the fact that we're getting older and older. We're changing jobs less often, and so we kind of get less of this wage increase over time. My biggest concern is that these trends for the moment have been moving in parallel. Globalization has increased demographics, people have become older. Both effects have put downward pressure on inflation. The globalization pressure, the globalization effect is probably coming to an end.
I was going to ask
most of it was driven by China.
Right.
Most of it was driven by China, and China is now, at least in its urban maritime areas, advanced economy. And so this country is certainly no longer contributing to the same effect, to the same extent, to global disinflation as it has been done in the past. And so that question is, to what extent are the factors mitigating each other, and is there a risk that if globalization comes not to an end but slows down, that then the inflationary pressure that we haven't seen in the past will come back? And I think that the question is, if they come back, how quickly do they come back?
Well, there's so many other questions that derive from that. One of them being, it could be that the wage pressure will be lifted off a little bit by the demographics, but the demographics also have the flip side of the coin, which is the liabilities. So it creates massive liabilities for those people who are retiring, and then pension holes in a lot of budgets and things like that. Hence, a lot of it, I feel, is an incentive for governments to monetize their debt and their liabilities on the future, and their inability to do so right now. And then at the same time, you have to care about the economy, and given how COVID is impacting labor and therefore everything else, it's extremely complex, I understand, but is the liability over the long run also going to act as a tax, if you want, on the wages?
Well, I mean, I have a very pessimistic view on these what we call contingent liabilities, because, I mean, unless you're in Switzerland or in the US or some other countries that have private liabilities to pensions, most of it is held in terms of promises from governments.
That's right.
And these promises can be broken. And I mean, I have to say that, if you see even a country like the UK, where the pensions, public pensions, have been delinked from nominal GDP to link them to inflation, that's already a way of kind of reducing the pressure on pension systems. You obviously create other problems in terms of old age poverty. That is likely to become a more important problem. But in a sense, we shouldn't kind of weigh too much on the idea that governments will monetize the debt. They will probably break the promises.
Right, but I mean, there's so many ways of defaulting on your debt, right? I mean,
well, it's not the defaulting. It's just, I mean, there's no debt because it's a contingent liability, and
well, it's an accounting trick. You can
Yes,
you can
exactly.
see it this you can see it this way. But you look at the U.S., right? There is unfunded liabilities, right? So they are what they are, which is they are unfunded.
Yeah.
They are liabilities, and we don't know how we're going to pay them. And I think it's pretty fair to say by most economists that we know that the payment mathematically cannot be paid. But then there is ways and ways to not pay it, right? One way is inflation, right? I would put a mix of 30, 30, and 30, right? With 30% of devaluation of the currency, 30% of removing. If I promised you 1,000, maybe I only pay you 700, and then maybe 30% on actuarians working out how much more you need to work in terms of age in order to figure out that if you push it to 69, 30% of them will die before they touch the pensions.
But that's also a break of the
Well,
the promise.
that's what I'm saying. Like
That's-
which mix do you want to have,
yeah,
right?
yeah.
Which haircut do you want to get? But let's go back to monetary policy. How can monetary policy and how come CBDCs help central banks to achieve their goal? Is this actually helping, or should they just go back to what they used to do because that's what they know?
I mean, I think the big question is, what is the problem you want to solve with CBDCs?
Right.
And I think that if it's just another e-payment system, I would say there's not much of a problem to be solved. If these central bank digital currencies can help to promote more the development of more digital token markets, as I mentioned before, that is something I would see. Yes, that is a possibility. To create more incentive to actually develop services that are linked, financial services that are linked to CBDCs. I would see that as a possibility. And in this sense, it might actually be interesting for central banks to go that way and help creating. I mean, especially if you think about the discussion currently at the European level, the ECB is very promoting all this green investment.
Yes, it's true.
If the ECB really wants to say, well, we want to promote green investment, and one of the possibilities would be to go through digital tokens, then yes, CBDCs could actually help in developing.
So trying to conclude here, let's look at the global angle from a trade perspective. China is developing a CBDC. The US is obviously thinking about it. And the private sector is coming up with their own solutions, right? So Bitcoin is one of them. I have my own initiative backed by gold. How do you see these two juggernauts, which is China on the one side and the US, both from a monetary and trade perspective?
Well, I think the first point to make here is that that obviously having these two big powers developing their own payment solutions is potentially creating enormous frictions in global trade. I mean, the idea obviously of having one reserve currency is always to kind of make all these trade invoices much more easier, because you basically invoice in one currency. If you have now one other big player that tries to kind of promote its own solution, that might actually create much more friction than we already have. And so I think that if that for the moment it's just a financial innovation, but if that financial innovation is being used to cut people off certain markets, and especially in the case of China, you would expect that that's one of the strategic goals, to say we can control who is trading with us. I think that might actually be an enormous problem for the global economy and for globalization.
Well, I'm thinking about two things. The first one being that, unfortunately, throughout history, you see that currency wars sometimes evolve into trade wars sometimes evolve into full-blown out wars. That's the first thing. And I'm thinking, and that's also why I was looking at this monetary reset with the name of, let's try to look at scenarios, right? For the purpose of intellectual simulation and for the purpose of trying to forecast as much as we can things. That's the first one. But the second one is, I am extremely interested in the area of the Chinese Belt and Road Initiative, because the trade partners are very important for China. But the dominance of the US dollar in the payment system today is unquestionably by the US, but sometimes people say it is being questioned now. how do you see the dynamic in the area, and what do you think this will evolve into?
Well, I mean, as I said, I think that the quick question is to what extent can China offer financial innovation that is sufficiently interesting for all those partner countries to actually start invoicing in renminbi then rather than in dollars. And clearly, to the extent that China is not only trading with these countries, but also providing financial resources, especially in terms for public infrastructure investment, etc. This could obviously mean that more and more of these countries will be forced to invoice in renminbi then rather than in dollars, and that clearly will then create a competition. Now, to what extent it will cut these or force these countries to make a choice between whether they trade with the dollar block or with the Chinese block, that's a different issue, and I think for the moment we are not there yet, partly because the financial markets in China are not as developed yet as they are in the US, and you still need a whole lot of other financial instruments if you want to run an economy efficiently. So I think for the moment this is an interesting perspective and clearly can evolve into something much more strategic and potentially conflictual. But for the moment I would say that this is only in its early beginnings, and it's not entirely clear whether this will develop any further than that.
Right. Well, I mean, from a private sector perspective, I see this as good to have more competition on money, because that might, in my view, as a citizen, push central banks to increase the quality of money, as opposed to try to depreciate it. And if not, then the private sector would do it, right? Which is my initiative. But then the other thing that I'm really focused on is, it seems that increasingly you see money and central banks politicizing the currency. So it would be the US choosing by who is in the SWIFT and who is not, embargoes and things like that, and possibly China doing so the same by sponsoring some infrastructure and then maybe having the use of renminbi as a bargaining chip as well, right? Should money be politicized, right? And is it not that we might see, because of external pressures such as Libra, such as Agao, such as Bitcoin, that people can have a third choice, right, by not participating in either one of those, and so that you could see somewhat of a revolution of the separation of the state and money, just like you saw the separation of the state and religion, because as of today we see that normally central banks are independent from governments, but most economists will tell you that it's actually not really 100% true. So what's your opinion on what I just said?
Well, I think that if you ask me whether central bank policy should be politicized, I would say no. In principle, I mean, as a good economist, I would say that you have one objective, that's your monetary stability. That's already enough. And I think that what you see in some central banks currently happening, where they're trying to achieve several different objectives, it's unlikely to be particularly effective either. I mean, I think that you dilute your initial mandate and you don't really achieve the other one. You can maybe have a mandate like a dual mandate like the US, the Fed has. By kind of stabilizing employment, conditional on having a stable money. But I mean, having a stable money, stable employment, and all these other objectives, I think that's way too much. And in principle, governments should be much better prepared to go another direction, which is creating sovereign wealth funds.
Right.
And investing strategically in some of these sectors. I'm a big believer of this route, and it doesn't have to be only oil money that you can.
We'll go back at that, but before I want to throw a stone at you, because if you say, and I agree with you, that the central banks should not be diluting their mandate too much, then what do you think about the ECB and including the climate change in their decision-making process?
I'm not convinced that this is the right way to do. I think that first of all, the ECB does not necessarily have the expertise to be able to identify which are the right bonds or which are the right investment.
Quantify that.
Yeah, exactly. And I mean, maybe they can build up this expertise. Obviously, they can if they want to. But the question is why should they do it? Why shouldn't they leave it to, for instance, private sector rating agencies, etc., who do these jobs and who actually, as you said, have a strong private sector incentive to actually provide good ratings. So for me, that's not obviously why the ECB should do that and why you wouldn't want to leave that to the market.
Right. I remember UNCTAD panel with central bankers where that was one of the questions on climate as a natural inclusion in urgency to be included in the policy making decision, and my strong opinion was to stick already to your mandate, which with the track record is not super good, because that'd be good already if you could do that one mandate well, rather than trying to add more.
And plus, I mean, the question is also where do you stop? You know, you integrate climate change, okay, but we have poverty problems even in Europe.
We have gender problems.
We have gender problems, exactly. I mean, then you kind of say, okay, well, why don't we treat all these problems? And all of a sudden you run into dilemmas because then you have trade-offs that you have to face. For the moment, we don't have a trade-off because inflation is so low. But imagine you have a trade-off that at some point you have to say, okay, well, I want to have the green transition.
Do we sell the children or do we sell?
No, but I mean, if you imagine you have a situation where inflation starts to pick up, and then you say, okay, well, now I have the trade-off. I want to invest in green, but which might actually bring in more inflation because all these companies are not productive enough for the moment. So I have the trade-off to make between having even more inflation, but green investment or not. And so this is where this mandate becomes extremely complicated. For the moment, it's a luxury problem because they don't have inflation. But I think
so they can just print.
Yeah, exactly. Yeah.
Right, but like it makes me laugh because it is kind of like, do you save the children or do you save the woman? Do you save the children because you're going to pay this back further on down the road? Because it's going to be the generations to come who are going to pay for this, or do you save the woman because there's an urgency problem on the gender gap and all sorts of other issues, but do you even have the tools to do anything about it, right? Okay, so let's switch.
But I just want to add one point to this, because this is also something I felt strongly already at the time when the ECB was created, is that having one mandate is very good, but it has to be one mandate that has to be democratically legitimized.
Right.
In the case of the ECB in particular, the inflation mandate, so neither the monetary framework nor the actual target was democratically voted for. The only mandate that got, you are independent and you have to guarantee monetary policy. Whether it's an inflation target or a two-pillar strategy as they had in the beginning, etc., was totally left open, which means that there is no democratic control over what these institutions are doing. And now you add another mandate, saying, oh, we also do green, you know, but who is controlling these institutions? There is no democratic control over these institutions.
Well, I think the European Union as a whole has a lot of democratic problems, and we saw that in Greece.
Fair enough. Yeah,
so I mean, we're lucky to be in Switzerland.
Okay. And I agree. On that one, we can agree.
and I think that is a model for democracy. It's not perfect, but it works well. Again, thank you very much for being with us. What would be your message to the audience if you had any message that you think is important that we haven't mentioned?
Well, I think the message for me would be really that kind of focus on the possibility that these new digital tools give you to solve problems that we haven't thought about yet.
Right.
And for me, the problems that we haven't solved is really sustainability issues.
Okay.
And I think that is where these new financial tools can really make a huge difference.
Okay, so thank you very much, Ekkehard.
Thank you.
I hope to see you very soon.
Absolutely.
And we will conclude with this. Please like and share, follow us for the next episodes. And I hope you enjoyed. If you did, like, share, and subscribe, and also support us by commenting and asking more questions below.
We will stand on principle, or we will not stand at all.